an interesting dividend stock to watch in 2025 is Philip Morris. Philip Morris is certainly well known in the industry it operates in, namely tobacco. Not really loved by most investors. It also doesn't meet the ESG criteria and probably doesn't meet many ethical standards. And that's why these kinds of companies are often undervalued when things are going badly. Well, Philip Morris is actually not one of those cases. It seems to be a bit overvalued. Still, it could become an interesting dividend stock. They are what can surprise us. And in this analysis, I will explain why. Now, the current share price is 117. According to Morningstar, the intrinsic value calculation is $120. And that's why it gets 3 stars. 3 stars, why? Because they indicate that it has a formidable, strong competitive advantage, or an economic moat. Now, the moat trend is actually negative. That's interesting. We don't see that very often. That basically means a company that is that's quite something, isn't it? There is a declining trend regarding the fundamental developments of their strategic position. So that's quite remarkable. However, I live in the Netherlands. Philip Morris also has many facilities in the Netherlands. I live close to one of those facilities, and I know that a lot is being invested there. But the company also makes a lot of profit. It really has enormous cash flow. So I wouldn't just write off the strategic developments for the long term. But of course, the industry it operates in is not for everyone. By the way, I don't invest in it myself either. Philip Morris, it's not a stock that interests me as a growth investor. But as a dividend investor, it can be interesting. Now, the current price target is 136 according to Wall Street analysts. And that's actually it. Investors from Wall Street expect that this stock can outperform and actually increase in the short term. If we really look at the historical valuation, we see that Philip Morris currently seems to be slightly overvalued. If we zoom in on a more current time frame, then the difference between the intrinsic values is even smaller. So the difference isn't very big, but then there is no margin of safety anymore. And soon a bit more about how you might benefit from that, or I should say be able to handle it. The price for Eurus right now is around 18. Then it's slightly above normal multiple, because the normal multiple is around 16. And actually for the very long term, as you can see, even at this price level, the estimates from analysts are still quite positive with an EPS growth of an average of 10%. That's not very unrealistic for this type of company, but it might be a surprise for you. If you look at the normal multiple of 15.9, and let's say the EPS growth is realized, well, it's never exact according to these forecasts, but let's say that's a bit average in line. Then in 3 years from now, you could achieve a 35% return if you jump in now. And that could mean an average return of almost 11%, including dividends. If you look at the S&P 500, which has a price to earnings ratio of over 25, then Philip Morris has a low earnings multiple, and also an EPS growth of possibly 10% per year isn't even that unattractive. Looking at the factor analysis, Philip Morris scores high on the quality rating, even a strong buy, but valuation and growth are not yet super attractive. Well, it has a very high profit, and the momentum is okay, and the revisions are positive. That means the analysis expects the company to make more profit than initially projected. The current price to earnings ratio is therefore around 17 to 18. Initially projected, the current price to earnings ratio is therefore around 17, 18. The luck ratio is currently really below 1, but next year it's estimated to be above 1. The price to cash flow is 17, which we just saw with 4.5%. Overall, everything seems not cheap at the moment and possibly even slightly overvalued. I'll talk more about how you might deal with it shortly. The revenue and profit growth are pretty decent. And what we really want to focus on is the EPS growth for the longer term. 3 to 5 years, well, that's also estimated here at 10%, so that aligns with the databases. Look, and that profitability is, of course, super high. 26% profit margin, even with an EBITDA margin of 40%. And the 5-year average is also around the same level. So it's not that it usually has spikes upwards. No, Philip Morris generates standard high profits. I already mentioned it, the company generates a lot of cash flow. Yes, it is a capital intensive company, which is a downside. At least it depends on how you look at it. So they have relatively higher CAPEX. But if you generate a lot of cash, then you can also invest a lot of cash. That maternal total capital is surprisingly high. I think so, 20%, and even the 5-year average was 31%. Quite remarkable figures for this type of company like Philip Morris. Or also, British Tobacco with the ticker BTI. An analysis that we previously shared on our channel. That's also a high dividend stock with more than 6% dividend per year. That can sometimes surprise you. And BTI is indeed doing very well. So you want more shares, analysis, ideas, then of course follow us on YouTube. I think it's going to bring a lot of enjoyment, even if it's just for inspiration after the research, because we actually analyze thousands of stocks weekly in various screeners. And we do it for ourselves, but also for our members. Deep dives into certain companies to see if they are good long-term investments, but we don't know the fourth morning inside out. So this is also a screen stock. So this is more for inspiration. Everything looks okay. The dividend yield is 5% of the 4-year average. At the moment, it's 4.5%, and we expect it to rise slightly to 4.6%. Looking at the dividend consistency, Willeborgs is very interesting for dividend investors. Even though the stock, let's say the company, might raise doubts about its viability given the industry, but the company continues to perform against expectations, so that's really good. The dividend history is ample, as you could say, with 16 years of dividend growth and also 16 years of consecutive dividend payments, but especially 16 years of consecutive dividend growth is really very strong. The Feed Morris, whatever you think about it from emotion, if you purely look at the facts, the statistics and data, then it's just a great growth stock when it comes to dividends. I have to say, a dividend growth stock, at the moment, the price is fluctuating, so minus 12%. And even now, it's still not a super attractive buying level, as I mentioned. So what would be interesting at this moment, specifically at this moment, in 2025, the stock market is declining. That's positive. Why? Because ultimately, many stocks will continue to decline because of that. So Philip Morris might drop to a price level of around 100. That means another drop of 11% compared to the current level. And actually, compared to the previous level, minus 20%. The stock might stabilize at the price level of 100. Then we actually get a more realistic instant moment. Then the price is a bit around the price earnings of 15. Then it comes back to the intrinsic value. It could be that if a real kind of bear market comes, the stock will drop further, maybe down to 90 or but below. But I don't see that happening very quickly, that it will drop a lot further. Imagine you're lucky and patient, and you can buy Philip Morris at a price level of 90, and the EPS. In estimates and your own forecast, you still said that the company is going to make 10% store profit per year. Well, then it seems to me like a very good one, dividend stock. But personally, I wouldn't jump in at this moment. I would wait for the current developments in the stock market, because everything is starting to decline now. And also this rate here could possibly continue. You never know exactly until when. So actually what's more important is investing in high quality companies. How do you recognize that? Well, Philip Morris has, for example, a very high profitability. That's one of the criteria. Other criteria, it has a large market growth. The company has innovative developments to sell new products, to stimulate further profit growth, and does it, for example, have very strong management? You need to determine all those kinds of categories for yourself. So do thorough research on Philip Morris. For me, it's not a buy. It doesn't fit in my portfolio either. I am a growth investor, but all in all, those are personal choices. I hope you found this analysis interesting enough. Do you want more deep dives? Then take a look at our website, happyinvestors.nl, for Dutch, or businessinvestors.info for international. Then you'll find dividend analyses. 1. Dividend. Stock per month. Really a deep dive. And a monthly update on dividends. Stocks. That's about our company. Good morning. There is upside potential. But maybe for the short term, just wait until the price has dropped further. Then you're in luck. Can you buy with a bit more margin of safety around the intrinsic value, or maybe even below it? And in the meantime, just 5% dividend per year collecting. Thank you for watching, and see you next time.